to our NFIB Pennsylvania webinar. I'm Suzanne Stoltenberg with NFIB Pennsylvania. This webinar is all about SBA loans, benefits, eligibility, and rules. And if you have any questions during the broadcast, feel free, please, to type them in and we will get to them. Now I'd like to thank our sponsors, if I could. They are McNeese, Wallace & Nurick, the law firm, UPMC Health Plan, Members First Federal Credit Union, and Capital Blue. And I wanted to thank Members First especially because they've provided our presenter today, who is Eric Fischer. He's Vice President of Business Lending Sales. Thank you so much, Eric. This is going to be really valuable information for our small business members. So proceed.
Thank you, Suzanne. Appreciate it. And welcome, everybody. And thank you so much for joining us this Thanksgiving week. I appreciate it. I'm sure it's a busy week for everybody. And I hope everybody's getting ready for some fun for Thanksgiving. Okay, let's talk about SBA 7A lending. Let's go ahead and get right into it. What is this whole SBA 7A loan anyway? So I thought I'd start with the basics and tell you that the SBA stands for the Small Business Administration. It is a federal government program, which means it's a program that's spread all across the country. It's actually led by a White House cabinet level position called the SBA Administrator, who is currently Linda McMahon. And if anybody, if that name rings a bell for anybody, if you think of WWE, the World Wrestling, I guess maybe it's Federation, was one of those two. But this is Jim McMahon's wife. She was the president and the CEO of WWE before she came over to the SBA. So a little fun fact for you. And here's the mission of the SBA. And I kind of like to share this with folks just so they get a feel for what this whole thing is about. It's to aid, counsel, assist, and protect the interests of small business concerns, to preserve free competitive enterprise, and to maintain and strengthen the overall economy of our nation. And that whole broad sort of scoping concept there really means that the SBA exists solely to support small businesses, and they do it in a number of ways. And one of them is, and here it is in red, is through this SBA 7A loan, the federal government actually guarantees your loan with your financial institution, bank or credit union, whoever it happens to be. And that's what we're going to talk about today. What is this whole government guarantee behind my loan, and what does it mean? Okay, so I promised that I was going to talk to you about the roles and what everybody plays. It's a little bit of a busy screen here looking at, but I wanted to give you some kind of representation of what are the relationships here, and how does the SBA fit into all this thing. And the big box that you see, I'll hopefully pull up my cursor here, this big old box here represents what basically a standard loan looks like. No different than any other loan. Here's your bank, and your bank agrees to provide money to a company of some sort, and that company in return plans to repay that bank back the money. And in the structure of this loan, in this box, big old box here, is you typically have a couple people that own the company, and they become guarantors of the loan. So they're behind the loan too. Notice that guarantee word I used again. It's going to come up again, because your guarantee here as a personal guarantor is different than this guarantee sitting down here. So I've got a couple people here guaranteeing the loan, and then I usually have some collateral sitting there supporting it as well. So I might offer up a building, or maybe it's my business assets, things like that. There's your standard loan, bank and company, between the two of them. But here we have a third party, and that third party is the SBA. And you'll notice I put a separate box around the bank and the SBA, because the relationship, the true relationship here with the SBA lies between the SBA and the bank. They are there, and they are here to support this loan, but the true relationship lies here. And I'm going to show you how and why that is in just a second. So let's go next slide. Okay. Oh no, we're in default territory. And I know this is sort of the morbid piece of the conversation, but believe it or not, when I sit down with clients, I do like to explain this to them, and I hope at the end you'll see why. Oh no, we're in default. The company has gone dark, here you see, and the company stops paying. So I talked about how we have guarantors and collateral supporting the loan, and I have the SBA down here supporting it too. Well, what happens is the SBA will sit on the outside of this relationship. They'll sit in the corner over here, and what they tell the bank is, Mr. and Mrs. Banker, you need to go get every dollar that you can out of the loan that you provided to the company, which means go get from your secondary sources, your plan B, your repayment sources, go get as much money as you can from the personal guarantors and from your collateral. Go liquidate that too. I kind of use this term. You got to go squeeze blood from stone, everything you can get. And we're going to sit here and we're going to watch all that happen. Okay? And then at the end, if plan B doesn't work, oh no, we tried to get everything we could from our personal guarantors and our collateral. There's no more blood to squeeze out of it. We're done. This goes dark too. Now I have what's called a deficiency of some kind. So let's say I did $1 million loan and I have $100,000 I couldn't get back. I've identified now $100,000 of deficiency in the structure of the loan. That's when the SBA guarantee kicks in. And it is called a deficiency guarantee because they will wait on the outside of this relationship, wait till the deficiency is identified, and once it is, once you identify and what happens is the bank here has to send a whole bunch of documents, see that? Bank documents, all its collections efforts, everything that it can do to get its money back. It applies to get paid from the SBA, and the SBA will pay a portion of that loss. So if it's a $100,000 loss, maybe this loan carries a 75% guarantee on it. The SBA would write a check to the bank for $75,000 out of that $100,000. This note here at the bottom, I want to note, is the guarantees that you'll get from the SBA typically range from anywhere from 50% to 90% of the deficiency, but usually most of the loans that you get are 75 or 85%. Okay. Why do I explain that to you? I like to go through that with folks so that they understand that the SBA guarantee is out there to help reduce risk to the bank, not the borrower, okay, but reduce risk to the bank. It doesn't take the risk away, okay, and there's still risk to the bank. If there's a loss to be taken, the bank is going to take a loss. It just takes less of a loss than it would have, which leads me to, why should you care? Okay, so I've got this banker, this credit union guy who's saying, you know what, I want to do your loan with an SBA 7A guarantee. Well, you need to care because what the banker or the credit union is telling you is, you know what, I don't really want to do this loan conventionally. There's just a little bit too much risk in it. But if I add a 7A guarantee to it, it's reducing the risk to the bank. Okay, it doesn't eliminate it, it does reduce it. So it might make the loan palatable enough that, okay, the bank or the credit union is ready to do your loan. There are some other benefits to it, and that is it can get you, this is the big one, get you a bank loan, this is what I was saying, get you a bank loan in circumstances where you don't fit into that sort of bankable credit risk. Okay, there's something in that loan where the bank's saying, I don't know about this, and I'm going to give you some examples of what those things might be. It creates some flexibility in loan structures. Because of the additional guarantee, the bank might say, maybe I'll stretch out the amortization a little bit longer. Instead of a 5-year loan, maybe I'll give you a 7-year loan or a 10-year loan. And I'm going to go over a longer list here later on for you on some of the flexibilities you get. It also allows, there's some nice features in the 7A loan that allows flexible uses of funds, which we'll go over as well. But the bottom line that I always go through, there's the bottom big red one here, is it gets you your money where you probably aren't going to get it. So that's why the 7A loan matters to you. Okay, so who are, and this is a little bit from the perspective of bankers, this, but it matters to you. Who are those target borrowers for bankers when we're looking at deals? What are the weaknesses in a deal that we're looking to maybe strengthen? Okay, we use the word mitigate in the banking world, but what are we looking to strengthen in a deal? Well, the big one is typically collateral shortfall. So Could be a deal where we're looking at where we just can't get collateral, or the deal doesn't have collateral in it. Maybe you're buying a business, but you're not buying the piece of real estate, and so there's no collateral with it. Well, here's where that SBA guarantee will help me reduce my risk of loss if I can't get all my money back through collateral later on. Where else? Well, typically in a deal, banks look for 20%, maybe 30% cash injection in a deal. Well, maybe you only have 10. All right, well, I'll take on that extra risk, but I'll do that with an SBA 7A guarantee to help reduce my risk. Maybe I need a deal, maybe I need to structure a deal with longer amortizations than normal. I need a 10-year loan rather than a 5-year to help to make it work, make the cash flow work. Maybe it's a startup business. This is a big one. Most startup businesses go through the SBA 7A program. Or maybe it falls into sort of that risky industry. Well, what are those? Banks typically look at restaurants and hotels as risky industries, or industries where there might be some environmental risk sitting in it. I'm trying to think of a couple examples. A car wash would be one. Dry cleaners would be another. So it's sort of risky industries where we're looking to reduce risk. I'd like to go over this part, though. I always talk about those are the risks that I want to mitigate, but what strengths should a borrower have in a deal if I'm going to go 7A? What should always exist? This should exist whether I do a conventional deal or an SBA. But what am I typically looking for? I'm typically looking for a borrower that has experience, somebody I know that can run whatever business that they're looking to either buy or start up. Can they actually get the job done? If I don't believe somebody can get the job done and operate a company, I'm out. An SBA 7A guarantee isn't going to help me mitigate that risk. They should have good personal credit. So your credit scores should be solid. Folks that have poor credit, you might have a 590, 570 credit score, I'm probably just going to say no to. I'm not going to try to do that with a 7A guarantee. But the last piece that's really super important is the cash flow needs to work in the business. So meaning that the business must show that it has the ability to repay the debt. It's really important. The SBA, the government, will not allow us to book a loan in which we can't show that the borrower has the ability to repay that monthly payment going forward. So there's your target borrowers for a typical 7A loan. And I wanted to give you a couple real projects just to sort of give you a viewpoint of what does this look like. And I'm going to point a couple things out to you. This is a very busy graph, and I apologize for that. But I'm going to point a couple things out to you. These are real projects. These are actually projects that I have financed. This was a business purchase, this top one up here. And what I want you to notice is that this number here, this $1,379,000, you see, that's the total size of the project. So someone was purchasing a business for $1,350,000. They needed some working capital, and then we actually financed the SBA guarantee fee in there. In this particular case, the borrower only put in $5,700 to get that SBA loan. That doesn't happen in a conventional loan. Most banks are looking for at least 20% cash in. You might have to put $270,000, okay, on that project. Well, there's a risk we mitigated. Okay, you only have $5,700. This is, by the way, a little bit of an outstanding example. You don't see this very often. The other piece is this little 120 figure. This is how many months we did this loan. It's a 10-year loan, 120 months, 10 years. Normally, you would do a deal like this over 5 years. So we did a 10-year loan with that much money down with a 7A guarantee. A little bit different project down here. Here's a startup business. And this business, I can actually tell you, was a koi farm. Koi, I think that's K-O-I or C-O-I. It's a little fish farm. And here this person was buying some real estate, doing some renovations, needed some equipment, a little working capital. So again, a $500,000 project down here. Hopefully you can see that. They only put in basically 10%, $57,000, a little bit more than 10%. Again, unusual. Normally you would do that over with at least 20% down. And I want to point this out to you again. 262 months. So that's over 20 years. That's like a 22, 23-year loan, somewhere in there. Normally for a deal like this, you might do, I'm just looking at these numbers, might do a 10-year loan, maybe 15. So we're stretching out amortizations and we're putting less cash in. So these are the kinds of projects you look to do with 7A.
And just as a quick question, did these both go successfully?
They did. Yes. Yeah.
Good.
These actual deals that got done, they were underwritten by the bank and approved, and then approved by the SBA, and they got closed. Yep.
And they've been around for a year or two.
Oh yeah. Actually, this one at the top, I think was done 4 years ago.
Got it.
I'm trying to think back. This one on the bottom was done about 3 years ago, and both have been successful. Yeah. In fact, this top one, we did the business purchase, and then I just rode by that business. I was working at a different bank at the time. They have since bought the property, the commercial property as well, which you see wasn't in here, but they've done that. I can see that now. So good for them.
Great.
They're successful. Yeah. So let's go through some eligibility basics of sort of who and what you need to look like as a borrower to actually qualify for an SBA loan. The first one is you have to be a for-profit business. Can't be a nonprofit. So you have to be in business to make money. You have to be located in the United States. You have to be a small business only, I set up here, and that's by the SBA's definition. And I don't want you to have to know the rules and things like that. But there are two basic definitions the SBA uses. It's either by the number of employees you have, or this TNW, if you can take notes, stands for tangible net worth and net income. You don't have to worry about that. Your banker should take care of this for you, by the way. This is something that when you go talk to your banker, they should be able to tell you pretty much right away whether you're qualified or not. Just want you to know, you got to be a small business.
And isn't the SBA definition 500 employees or less?
It depends on the industry.
Ah, okay.
Yeah, they have a whole list of industries, and it depends. But for the most part, I'm glad you asked the question. I actually tend to look at the tangible net worth and net income number mostly. You'd be surprised. Just about everybody fits in. So to give you an idea, any business with less than $15 million worth of tangible net worth and averages less than $2.5 million worth of net income, that's the bottom line, over the last 2 years qualifies. That's pretty much everybody. I mean, it's very, very rare do I run into businesses that don't. And for those that don't, I can pretty much almost guarantee that they don't need an SBA guarantee to get a loan. They should qualify on their own. So, yeah. The next bullet here is if you happen to be a franchise, which many times do go through the SBA, there is a franchise eligibility checklist you sort of have to go through. There's a registry out there on the SBA. You can go look to see if your franchise happens to be registered. The SBA reviews every franchise agreement that they finance, and mostly what they're doing there, in case you're wondering, is they just want to make sure that the franchise they are financing doesn't have too much control over the individual owner within the franchise agreement. Sometimes they look at franchise agreements and say, you know what, this mother franchisor just is exerting way too much control over the individual owner, and we're not interested. Which basically means that looks like they're financing the mother franchisor instead of the individual owner. So you got to make sure that, again, your banker can do that for you and should do that for you. You must, in red, here it is again, you must have an operating business. So you might be a for-profit, but if it's not an operating business, let's say it's an investment property company, that does not qualify. So if you're in the business of buying a property and leasing it out to somebody else, SBA is not interested in helping you finance that. They want operating companies. They want companies that have employees that have some kind of operating business within them. You must also have a personal guarantor on the loan. They will not do a loan without some kind of personal guarantee. And there's a 20% ownership rule there, so they look for anybody who owns 20% or more of the company they're financing to personally guarantee the loan. So those are the basics. There's a whole lot more rules than that, but those are the basics for you. And here are the eligible use of funds. You might recall that I said there's a lot of added flexibility in these loans with use of money. You can do, what's cool about the 7A is you can do almost anything you can imagine with a commercial loan through the 7A program. You can buy real estate. You can renovate real estate. You can construct real estate if you want, ground up. You can do leasehold improvements within a property that you're leasing or renting rather than owning. You can buy machinery and equipment. You can use it for permanent working capital or revolving working capital with a line of credit. You can buy a business, which we've seen an example of, and you can even refinance debt. I write in that there are restrictions to that, and there are some rules that your banker should know. You shouldn't need to worry about that. You can't refinance everything.
I do have a question, and it relates to that, so I jumped in at this point about debt refinancing. There is a question: can you be an existing business and want to refinance or equity to expand? And if you have more than one business, do you have to include all to qualify? And what if collateral is already used?
Okay.
That's about 3 questions, but
yeah, I'm gonna try to make sure I catch them all. Okay, Suzanne.
Okay.
All right. So if you're already an existing business, the question was, can you refinance
and want to refinance, or you want equity to expand? And that, if you have more than one business, you've basically said you can refinance debt with restrictions, so that's probably specific. Also, if you have one business and others, do you have to use all of them to qualify?
So,
and what if collateral is used?
So the answer to the first question is yes, you can. You can refinance your debt. You can use equity you might, let's say, have in a building to reinvest into the company. That's fine. As long as that money is being used inside the company you're looking to refinance. In other words, you can't refinance equity in one company and pull it out and put it into another one. Okay, that's considered cash out financing.
So you really have to stick within that one business, whatever the assets are for collateral, as opposed to going to another business I happen to own.
Yeah, the answer is yes, but there's some creative structuring that can be done. So, I mean, all depends on what collateral you're talking about.
This questioner should give you an email when we're all done.
You know what? A phone call or an email would be great. I'm happy to take an individual phone call there.
Okay.
Somebody wants to talk about it. But the answer is yeah, you can refinance. The second question was about, do I have to include every business? No, you don't. What your banker should do is just focus on the business that you're financing. So whatever operating company you're working with, there's my borrower. What I do have to be careful with, and the way I respond to this is, I mentioned something about collateral shortfall being sort of the primary use of an SBA guarantee, and there's a big caveat to that, and that is trying to explain this the best I can. I can do a deal for someone completely unsecured as long as I take whatever collateral is available to me. Okay, so what I can't do is leave collateral on the table that might exist either on somebody's personal financial statement or otherwise that maybe I could take. Now, that does not mean I have to reach into another company to go get collateral. I don't have to do that, but I do have to look at someone's personal financial statement and say, let's say, for instance, somebody says, well, I want a line of credit for my business, but I really don't have any business assets here. Let's just say it's a service company of some kind, doesn't have much available. I do need to dig into somebody's personal financial statement to say, well, if you have a home, what do you own personally? So I am going to dig in that far to look for other things to help support the loan, but I don't have to go into other companies and go get their stuff and go attach that as well. Hopefully that makes sense.
Okay, great. Yes.
And the last question was, there was another piece.
Well, you did address it. That was the collateral. You got through all 3.
Okay, good. I got through all 3. All right. Well, ask it again if I didn't, whoever that was. Ask it again.
Okay.
Or call me.
All right.
Okay. Let's see here. All right. So how long will you have to pay it back? The amortization is basically driven by your bank, how long they'll amortize it with some howevers in there. One of them is the SBA has rules associated with amortizations. The good news is those rules are almost always, I can't think of a case where they're not, more lenient than what a bank would typically do. But there are, what I really want to make sure you know is there are limitations to it. And so, for instance, I'm going to skip down to this section on the left. If you're using money for real estate purposes, the maximum amortization you can do is 25 years. If I'm using them for leasehold improvements in a rental property, or property I'm renting, I should say, I can only do a 10-year loan on those. FF&E, working capital, the same. That's the furthest out I can go. And of course, as with anything, I say there are little intricate rules in there too. I can actually extend a little bit if I happen to be constructing something. I can extend this 25 years by the construction period. So let's say we know it's going to take you a year to construct the building. I could actually do a 26-year loan in total, 1 year for construction and then 25 years for the principal and interest payback. So that's on the term loan. I'm going to make a comment here about amortization too, and that's the second point. There are no balloon structures allowed in any SBA loan, which is different than a standard bank loan. There are almost always some kind of balloon structure. And the reason for that is this is where the SBA is coming to the defense of its small business owners. It's basically saying to the bank, hey, if you want my guarantee, I'm not going to allow you to put a balloon on this thing and force the borrower to repay your loan in 5 years, even though it's a 20-year amortization. They don't like that. They consider that an unfair and unreasonable practice. I can tell you that no banker is going to feel that way, but that's what the SBA does. It's their rules. And my note here is that term loans and lines of credit are different. And so you'll have two boxes here. There are your term loans. And now, if you don't mind, let's talk about lines of credit. So lines of credit are different. They are structured very much like a bank line of credit, and then it's interest only, and they're revolving. So the bill you're going to get is for interest only payments. But remember, I said to you that there are no balloon structures allowed on any loan done by the SBA. That includes lines. So where a bank would typically write you a conventional line of credit with an on-demand feature, meaning they could call that line whenever they want. Not so with an SBA loan. They don't let you do that. They tell you must put a hard maturity on that. In other words, the bank must be in that deal for a period of time. No ifs, ands, or buts. So they all have hard maturities on them. Typically, you're going to get a 2 or 3 year hard maturity on that line. There's that no on-demand language allowed. And you have a maximum period of 5 years for the interest-only payments, and then something needs to happen. You need to start paying it back, similar to a home equity line. If anybody has had a home equity line where you have a draw period for a number of years and then you have to start paying it back. Same thing with the SBA. You have 5 years of interest-only payments and then a 10-year maximum to pay it back, meaning after that 5 years of interest-only, it has to flip, and you can do maybe another 5 years of principal and interest payments to get it paid back. After that 10-year period, the guarantee goes away. So basically, the SBA says to the bank, "We're out." So, okay. Hopefully that makes sense. If not, please ask a question. All right. What will it cost you? We wanted to go over that too. So, interest rates for SBA loans. The SBA has maximum interest rates, just like they have maximum amortizations for loans. And it's dependent on which program you're in. There are lots of little sub-programs in the 7A program, and it depends on your loan size. So I can't capture every instance here. What I wanted to express to you is the highest they typically go is through the small express, small loans, very tiny, less than $25,000. Either the express line of credit program or the export loans. They can actually go up to prime plus 6.5%. Okay, but that's not typical. These are rare loans. Matter of fact, I'm not sure I've ever done one at that rate. The typical pricing you're going to get is somewhere between Wall Street Journal prime, also known as New York prime, plus 2% to plus 2.75%. That's pretty normal. Okay, I like to highlight this for folks. Expect a floating rate loan on all your loans, whether it's a line of credit or a term loan. That's typical for banks to do. And the reason for that is most banks, when they look at these loans, are saying, hey, look, I'm taking on enough risk here on this one. I don't want to take on interest rate risk as well. In other words, if I offer you a fixed rate, that means I take on the interest rate of that loan. What rates might go up or down. And the bank actually takes on interest rate risk. Basically, the bank is saying to you, I want you to take on the interest rate risk. So if the interest rates go up, you're going to be paying a higher interest rate. Okay. All right. Hopefully that makes sense. Fees. What fees will you pay? I actually wanted to start out by telling you what you're not going to pay, and that is a lender may not charge you a commitment fee on these loans. In other words, I can't charge you a 1% fee that I earn on it. I can't do that. This is another place where the SBA is coming to the defense of small business owners. They're saying, hey, again, Mr. Banker, if you want my guarantee to help you out on this, I'm not going to allow you to charge this fee to borrowers. You will, however, be charged two two categories of fees. One is a packaging fee. I'll explain that in a second. And the other one is a guarantee fee. The packaging fee is meant to reimburse the bank for their helping you get this loan through the SBA. There's a whole lot of paperwork involved in these, lots of it, stacks of it. And the bank, whatever you're working with, they should be doing all that paperwork for you. You should have to do very little of it. And so that's designed to help repay them, reimburse them for their time and effort doing that. And you typically won't be charged more than $2,500 at most. Usually it's less than that, but for really large SBA loans, you might pay a $2,500 fee for. Theoretically, just so you know, you can get charged more than that, but it's cumbersome for banks to do that because they have to start documenting every moment that they spend on the loan, and no bank wants to do that. It's just too much administration. So typically banks max out at $2,500. And then you're going to pay this guarantee fee. Well, what is that? That's a fee that actually goes to the SBA, doesn't go to the bank, and it's calculated off the guaranteed portion of the loan. So let's go back to my $1 million loan example. If I have a $1 million loan with a 75% guarantee, that means the fee percentage is going to be calculated off $750,000, not $1 million. $750,000 is 75% of $1 million. And it's going to be somewhere in the neighborhood of 3 to 3.5% of that $750,000. So it's sizable. And I like to explain this for folks so they understand why the SBA does this. When the SBA funds itself, your tax dollars don't go to fund the SBA program. They're basically self-funding. It's like an insurance program. So if you're the borrower, you send a little bit of money into the SBA for your loan. So does 100,000 other people across the country who are all sending checks in. And every once in a while, the SBA has to write a check back to a bank. This guarantee fee is what pays for that. It's almost like an insurance premium in a way. So that's what you're paying for there. Okay? And it's dependent on the loan size. All right. What else will it cost you? Well, any direct costs to the bank, like appraisals, environmentals, filing fees, search costs, credit reports, those all can be passed and will be passed on to you as the borrower, just like any other loan. The SBA is okay with that. So you'll get charged those just like any other loan. And the other one I'd like to go over for you is what's called a subsidy recoupment fee, which is similar to a prepayment fee. But my first bullet point here tells you the lender is not allowed, again, the SBA coming to your support, is not allowed to charge you a prepayment fee on a loan. Okay? This subsidy recoupment fee does not go to the bank. It goes to the SBA. So this SRP, I've shortened it to SRP, is charged by the SBA, and it's only for loans with a maturity of 15 years or more. And it's structured, I know this is a little bit detailed, it's structured like a 5-3-1%, meaning if you repay more than 25% of the balance in year one, you're going to get charged a 5% subsidy recoupment fee on those extra funds you're repaying. And my last bullet point, it operates very much like a prepayment penalty from the bank, but it doesn't go to the bank, it goes to the SBA. So I'd like folks to at least be aware of that in the structure. Okay. All right, what does the process look like? It looks very much like a standard bank loan process, but you have one process in the middle here, which is the SBA approval process. Bank approval process, just like any other loan, you have to submit financial information and underwriting stuff. There will be some things that the bank asks you for that are specific for SBA loans. They should be driving that for you. You shouldn't have to know what those things are. And, the typical time to process for lenders is something like 2 to 3 weeks, somewhere in there. It can take longer than that. Most of that's dependent on how quickly you can get the information to them. And then you have to flip to the SBA approval side. Now, your lender, your banker, should handle this for you. You shouldn't have to do any of this. There is an application required. Your bank will basically pre-fill just about all of it out for you. You might have to check some boxes off and sign it, but they do most of that for you. And the turnaround time for that is about 2 to 3 weeks from the SBA. Now, there's an important distinction I want to let you know about. There's this thing called preferred lenders that are out there. Some banks will apply to be a preferred lender with the SBA. Now, this is a good thing for borrowers. This is good for you because that 2 to 3 week turnaround time I just talked about basically goes away. The bank is allowed, let me say it this way, the SBA has authorized the bank to basically approve these loans for the SBA. It's kind of cool. So if timing is of an issue for you, if that 2 to 3 weeks matters to you, you might want to look for a preferred lender in your area. But other than that, the only difference between a preferred lender and a non-preferred lender is the time it takes for the SBA to review it. So non-preferred lenders have to send in packets of information to the SBA.
How long? How do you do that? Go online and say SBA preferred lenders in your area?
That's a good question. Actually, I'm going to have to look that up for you, Suzanne. There are
no worries.
Yeah.
Okay.
There are lists out there. And you might be able to go to SBA.gov and look those up. The other way is just ask your banker.
Ah.
Are you a preferred banker or are you a preferred lender? They should tell you right away. So you have to go through that process. You need because you'll need the SBA approval to close, the SBA authorization, and then loan closing looks very much like any other loan. It's sort of 1 to 5 weeks, and it's very dependent on the collateral that you're using on a loan. Do I have to get an appraisal? Do I have to get an environmental report? That's typically 1 to 5 weeks. All in all, I like to tell people, be prepared for a 3-month process. That's what I tell them. It can go longer than that. It can go shorter than that. But prepare yourself for 3 months of working through it, and you should be okay. All right, what will you need to provide? So I gave you a whole bunch of stuff here. I don't want to list all of them out to you, but most of this looks just like a conventional loan, any other loan that you have to give. You need to provide financials for the company that you're looking to get a loan for. You need to provide, I'm going to point this one out, interim year-to-date financial statements within the past 90 days. This is important. This is a requirement from the SBA. The actual requirement, is it has to be within 180 days of the application. But I always tell borrowers, give me something within 90 days so that, as we go through the approval process, I have a little bit of time to work with. Okay, so it might take me a month or so to get this to the SBA. I don't want to have to come back to you to get updated numbers. So within 90 days usually works best. You need to provide a debt schedule. What all debt do you have? I'm going to go over this one. You have to provide projected cash flow statements. Very important. And typically they want 2 years. You absolutely have to do 1 year. And that first year has to be month to month. I always recommend give the bank 2 years worth of projections and make sure the first year is month to month. In other words, here's January's cash flow statement. Here's February's cash flow statement. March, April, May. The reason for that is the SBA requires a bank to make sure that they're analyzing any seasonality in your business. So there could be ebbs and flows in your business seasonally. Arita's franchise, which is locally here, is an ice cream shop that has clear seasonality in it. Okay, summertime's going to be big, wintertime's going to be slow, things like that. You got to have personal financial statements for all the owners and guarantors. I'm not going to go through all these things. Copies of sales agreements if you're buying things. If you're building something, plans and specs for the real estate construction. Resumes, really important. This goes back to that comment I made about making sure that the folks that you're financing can operate the business. Well, what's your background? What's your history? Let's show that to the SBA as well as the bank underwriters. Any franchise agreements, talk about those franchises. And the last part, and you can sort of read some of these things on your own, but the last part I like to go over is you might need a business plan too. In many cases, a lot of SBA loans, I do require that. So when might you need that? Well, startups, or if you're purchasing a business, or it's a new project for your business, like a whole new product line, let's say. Or here's another one. What if it's a turnaround story? Well, I've had some rough years, but I'm going to turn this around, and here's how it's going to work. You should put a business plan together for that. And the last piece I gave you, if there aren't any questions about that, is I like to give this to people. Okay, I need a business plan. What should that look like? I get that question all the time. I thought I'd just give you this. If you have to give a business plan, here's the basics of what that business plan might want to look like. And you can use this sort of at your leisure. But you should talk about the business, and here are all the details you might want to put in there. What's the project? Can you summarize it for me and give me the dollars that you need? All the financial data that you have for the company and the project that you're doing. And then here are some supporting documents. Some of these are actually repeats of the other list I had, but here are the supporting documents you might need.
So Eric, just so everyone can know, because they're not taking fast notes, I have been recording this, and we will post it on the website if you need to go back and reference this slide or others.
Yep. Okay. So questions, and I'd love to get some. I hope there are more out there.
And I'm not seeing any right now, but if you give us a moment and type it in, I'll tell you about something in the interim. Just briefly, so folks know, in January we have a webinar set up with Department of Revenue in Pennsylvania, two of the deputy secretaries who are dealing with taxation. And so if you have any questions you want to provide me, send Suzanne Stoltenberg at NFIB. You have an email from me about this webinar. It has my email there. Just send me any questions and we'll be asking them. Okay, I have not seen any questions appear. It's not unlikely people might still have some. So I want you to take a look here at Eric's email. You may email him, or you can email me here at NFIB if you prefer to keep it anonymous, and I'll ask Eric your questions for you. Well, Eric, is there anything else you'd like to top it off with? Otherwise, I want to thank you so very much.
No, I just like to thank everybody for chiming in with us today, and I want to wish everybody a happy Thanksgiving, and I appreciate the opportunity.
And I thank you so much for doing it, because it was excellent information. It was really clear. And as I said, I shall post it on our website, nfib.com/PA for Pennsylvania. Okay, Eric, take care. You also have a great holiday, and thank you all for listening and attending the webinar. Bye-bye.
Thank you.